Good afternoon, and thanks for joining us for our Corn and Soybean Outlook webinar. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me today are Dr. Nathan Thompson, who's an Associate Professor in the Department of Agricultural Economics here at Purdue, and Michael Langemeier, who's a Professor and the Associate Director of the Center for Commercial Agriculture, also here at Purdue. So we're having our webinar today in light of the fact that USDA just released updated supply-demand estimates, not only for the U.S. but around the world. And the report yesterday didn't have a lot of new information, but we'll highlight what was new and think a little bit about some of the implications here longer term. So if you look at the corn balance sheet, there was really no significant change in the USDA's corn balance sheet. The corn ending stocks number really didn't change at all. Ending stocks as a percentage of usage still hanging around very close to that 10% mark that we often talk about in terms of that being kind of a tipping point. When that ending stock number drops below 10%, we start thinking about things being tighter and maybe a little more volatility. So USDA didn't change that, although down the road it would not be surprising if they do change that in future reports. The focus of the market, if you look at what's gone on in the futures market recently, as well as this report and some other information, has really been on what's taken place in South America. USDA, again, this month did reduce their estimated corn production coming out of Brazil. This time they dropped it by, I think, 39 million bushels. That puts it down to 4.49 billion bushels. And if you look at the Argentine side, if there was a surprise, they made no change in their estimate of Argentine corn production. And I think a lot of people in the trade thought they might pull that number back in light of the adverse weather conditions Argentina's been experiencing, and also to some extent southern Brazil. So I think going forward, there's a lot of people in the trade that expect to see some lower corn production numbers than what USDA had on this report. It'll be interesting to see how that shakes out a little longer term. But I think if you look at the futures market reaction, clearly there's been an expectation that those numbers are tightening. If you look at USDA's forecast, their forecast is still for record South American corn production. When you put Brazil and Argentina together, they're still at 6.6 billion bushels. But most of the private forecasts that have been available here in recent days have been well below that. It varies depending on the source, but clearly there's an expectation that we've seen some yield reductions on the corn crop in, I think a lot of people think in Argentina, also to some extent in southern Brazil. And then concerns exist about where we're headed with the so-called second corn crop, the safrinha corn crop in Brazil, which is in many places just now being planted. So the market is paying really close attention to what's going on in South America, and I think it's going to behoove all of us to pay pretty close attention going forward. If you look at, instead of looking at ending stocks for the world, which is what I usually do, this time I went back and looked at the major exporters and looked at their ending stocks relative to world usage and put that data set together going back to 2000. And if you look at what they're at right now, ending stocks at those major exporters, which, for reference, I guess we probably should mention who they are. Obviously the U.S., Brazil, Argentina, South Africa, and Ukraine are really the major exporters around the world. I think Russia's in there as well, but Russia's actually pretty small. Ukraine has become much more important in terms of corn production and corn exports here in the last several years. But those are the major corn exporters. If you look at their ending stocks relative to world usage, USDA's projection is at about 4.4%, but it would not be surprising to see that come down in future reports. And clearly the futures market thinks that there's been a movement towards a tighter ending stocks figure than what USDA is currently projecting, probably putting us back where we were in that 2011, 2012 timeframe, to some extent also last year as well. So that's really the concern of the marketplace going forward with this tightening of stocks taking place that maybe USDA probably hasn't quite caught up with. So with that, I'm going to turn to Nathan Thompson. You've been looking at storage opportunities, and we're going to talk more about strategy later. But one of our question marks is, what do we do? We've got some corn in inventory, in many cases still substantial. What kind of decisions are we looking at? What kind of opportunities are out there?
Yeah, so I just want to start off looking at basically where we are in terms of forward contract bids for corn at a location here in central Indiana, just to kind of jump us off in that conversation. So if you look, the kind of darker gold line that runs across the bottom of the chart there, those are the forward cash contract bids for that local elevator here in central Indiana. And you can see We don't see a lot of appreciation in those bids as we look over the next several months of this marketing year. And really, we even see those bids actually decline as we move forward. And again, you got to think about what's going on in those bids. So again, part of that is carry in futures, which we have very little to no carry in corn futures as we look over the remainder of this crop marketing year. And then also basis. And again, as you can see from the bids, there's very little appreciation in the basis bids as we look over the next couple of months. And that's what leads us to this situation where those bids aren't increasing as we think about storing out into the future. And then the other two lines on the chart there are what I call kind of an implied break-even price. And so basically those are the prices that we would need to sell for if we were going to cover our storage costs. And so I've got an on-farm storage scenario. That's the gray line that kind of runs through the middle there, where I'm just assuming 1 cent per bushel per month of on-farm storage cost and a 6% APR on the opportunity cost. And then the lighter gold line across the top there is that implied break-even for a commercial storage scenario. So again, 4 cents per bushel per month of storage costs and the same opportunity cost. And so really what you're thinking about when you're looking at those lines is, okay, so if I have cash bid opportunity for delivery for corn here in February of $6.44 is where we were at this morning. What would I need to be selling that corn for, say, in May or June in order to just offset those storage costs that I've assumed? So you can see, right, if we're looking at a June delivery, we'd need to be selling corn for $6.61 a bushel just to offset an on-farm storage cost scenario, at least based on my assumptions. You'd want to pencil in whatever costs were relevant for your farm. And then for that commercial storage scenario, you're looking at a potential price of $6.73 just to offset the costs and be at an equivalent position to that $6.44 today. So obviously you can see that the current bids that are posted out there are not getting us anywhere close to those prices. Now there are other strategies that you could implement other than the forward cash contract that could potentially leave upside open to reaching those prices. But again, those are very high prices. And so if you're holding on to corn, thinking about what you're going to do here over the next several months, you really need to have a strategy in place of how you think you're going to get to the price levels that I have on the screen there for that storage to make sense economically.
Yeah, so Nathan, I think for most of our viewers, if they had corn in commercial storage, they've probably moved that by now. So most of them are probably thinking more about that on-farm storage scenario. And looking at that 644, that's a pretty significant movement out to June or May, right? You're looking at a fairly sizable move there. What you're really betting on is primarily an improvement in futures prices, right?
That's right. And again, there is, we've seen futures moving very quickly lately. So that opportunity is certainly there. There's opportunity for basis improvements as well as we get into the summer. And, if there was a situation where we felt like maybe we're going to have a short crop next year, we could get some pops in basis in that time frame as well. But again, those are the types of things that you're gambling on if you're looking to get to these price levels.
And I just think the key point here is to always remember that when that corn's in storage, it is incurring cost.
That's right.
You taking a look at the basis tool?
Yeah, so look a little more closely at what's happening on the basis side of things. From a corn perspective, really not a whole lot. Basis has been pretty steady since the beginning of the year or even going back into December. So here we're looking at corn basis in central Indiana. The blue line there is just the historical 3-year average. So that's kind of the normal trend that we would expect to see. The black line is what's happening in the current crop marketing year going back to the beginning of the marketing year in September. And so you can see here over the last several months that corn basis in this part of the state has been very steady and really close to or maybe slightly below that historical average, but pretty much following that trend. On the next slide, I have, again, corn basis, but this time in southwest Indiana. And so again, the basis tool has crop reporting districts for Illinois, Indiana, Ohio, and Michigan. I just try to look at several different locations to kind of get an idea. Again, there's not a whole lot different here. Again, basis in southwest Indiana has been kind of tracking along that historical 3-year average. The one thing is down there it has been a little bit weaker than that historical average. So again, if you're looking at this week, maybe 10 cents under that historical average, but not anything that would make us think that it's any strong deviation from that historical trend.
So longer term, you'd probably still stick with the idea that we'd see some improvement in basis as we head out into, say, May and June. Maybe not all the way back to the blue line, but maybe some upward trend from where we're at today.
That would be the forecast that I would use. Again, you know, the research that we've done, there's a lot of factors that can impact how you think about that. One of those being the horizon. So how far into the future are you thinking? And the research that we did said that, you know, if you're thinking relatively short term, say over the next 4 to 8 weeks, you would definitely think that it would move towards the blue line, but kind of continue to be at a little bit of a discount or running slightly weaker than that. If you look further than that, and again, at that point, you're getting out to the summer time frame where our research says that it's really hard to predict anyway. But as you look further, that horizon gets further into the future, you would generally expect to move back towards that historical average.
Good point.
So this is a little bit of this is a new chart that I've added this month. The last several months, we've been looking at basis bids at an elevator in West Memphis, Arkansas. It's kind of a river market location. And so we were thinking about it and decided, had some recommendations to maybe think about that a little bit differently. And so what I've done is taken all the locations that I have access to kind of along the river in southern Indiana, the Ohio River in southern Indiana and southern Illinois, and kind of average those together to create what I'm calling kind of a river terminal basis for southern Indiana and southern Illinois. And so what you can see, again, the blue line here is just the historical 3-year average, and it kind of shows you what the pattern tends to be for those markets in terms of basis, and then the black line being what's going on currently. And so you can see, again, we've started out with weaker basis. Again, that goes back to late summer, early fall of 21, where we had a hurricane that was affecting river markets and other export-related things. Since that time, right, we've had basis strengthen right back close to that historical 3-year average. We're probably currently maybe 5 to 10 cents below that, but really following that pattern that we would typically expect to see for those markets.
Yeah, so it's kind of interesting to think about those river markets in terms of their sensitivity to exports in particular, right?
Yeah.
And it does suggest that we're seeing some export movement, some good movement. And I think there's been a lot of discussion about us moving into a stronger export environment here these next few months. So it's going to be interesting to see how that shakes out, whether or not we see any additional improvement.
Yeah, well, that is the goal of this chart, right? Trying to get a feel on what's happening there on the export side of things, as those terminals tend to be heavily driven by that. And so, yeah, it'll be really interesting to follow kind of where that goes these next several months, especially as it is relative to ethanol plant basis. We've talked about a lot about, you know, ethanol versus export demand and how that's going to drive basis here over the remainder of the marketing year and even longer term. Like, what is the driver of basis in today's market?
So speaking of ethanol plant basis, you've updated that chart as well.
That's right. And so again, you know, I've presented this chart several times, but just to give you an idea of why there's so much going on here. So we've had very unusual situations over the past several years. And so you really got to take each of those years individually to understand kind of how they fit into the average. And you really have to go further back to find a time frame that I would designate as normal, which is dangerous, but nonetheless. So the blue line that kind of runs through the middle of the chart is 2015 to 2017 average. That's the last 3-year period that I don't have any kind of extreme events happening, and I'm calling normal. The green line is the 18-19, and you can see we have this big run up in basis in the spring, early summer. That had to do with the planting issues that we had in 2019. That caused basis to really increase in the Eastern Corn Belt at those ethanol plants as they were trying to secure corn moving forward. The red line is in the next year, 2019, 2020. We see a big drop in basis there in about March. Again, that aligns with COVID, reduced travel demand, reduced ethanol demand. That had a big impact on basis at those ethanol plants. And then obviously last year, we see the big run up in basis there in the summer months. But with all of that as context, coming back to the black line, which is a little bit hard to see because it runs through the middle there, that's what's happening this year. And again, we started with strong basis levels coming out of strong basis last summer, but we saw that really quickly revert to kind of more of a normal level at the beginning of this crop marketing year. And that has really stayed pretty steady, which has been a little bit interesting as you think about what's happened in terms of ethanol margins, ethanol production. But that ethanol plant basis in Indiana going back to, December has been, right at zero and hasn't shown us much one way or the other. So again, as you think about what's going on the export side, and then, what we're seeing in terms of at least the basis being a little bit of an indication of, what these ethanol plants are doing in terms of being aggressive for bidding for corn. Where is our ultimate source of demand? Exports are really showing a lot more positive movement on the basis side in terms of wanting to secure corn. Ethanol plant basis has just kind of been steady. And so it'll be interesting to see kind of where that goes as we look forward.
Yeah, the interesting thing to me as I look at this basis chart and think about what's going on this year is the fact that as the ethanol plants are either operating either at capacity or pretty close to capacity, they're obviously able to secure corn at what I would characterize as normal basis levels.
Yeah.
They haven't had to do anything extreme to get the corn in, which is kind of interesting. And at least in some locations where in recent years the ethanol plants have been the dominant bidders, they've been doing okay without having to bump the basis up. So it's going to be interesting to see how that plays out. But I mean, from your perspective, you're kind of expecting that blue line, that average, which was the 2015 to 2017 timeframe, to kind of hold here the rest of the year the way it looks. Is that right?
I mean, yeah, I have no information that would lead me to think otherwise, right? And again, you can look at this chart and see that we have wild movements one way or the other in the last several years for various reasons that can pop up. But as far as, looking forward, you would expect that to kind of follow that normal trend. And again, like you said, it's interesting because we normally see ethanol plant basis at a premium above, other end user or not end users, other elevators. And we don't have that premium built in. And so will we get to a point where maybe we see those ethanol plants bidding up, above other local sources of demand or not? And time will tell kind of how that factors in, or if they just continue to secure corn at more normal basis levels.
Yeah, it's just to me, it's an indication that they've got ample supplies to draw upon
Right.
and really haven't had any difficulty securing corn supplies to run the plants. So you've taken a look at opportunities both for old crop and for new crop, and I like the fact that you did a comparison of what's available today, and actually you updated this morning, versus what we were showing a month ago when we did our last webinar.
Yeah, so we always include some sort of chart like this or figure like this to help people think about where are prices, what are my opportunities, and when I made this chart, I just couldn't get rid of the numbers from last month because I was like, we have to make sure people realize what's taken place here over the last several weeks. So again, looking at a May delivery, so I'm just trying to think of something within this crop marketing year for people that still have corn in storage, what sorts of prices should you realistically be thinking about? So last month, I was saying, well, if you were looking at May delivery, July futures were at $5.88. I went to the crop basis tool for Central Indiana and came out with a expectation of what I thought basis would be for May delivery of 2 cents over. That would put us at $5.90. Move forward 4 weeks, roughly a month or so. This month's webinar, so this morning I was looking at corn futures for July of $6.40. Okay, so you're about 52 cents higher. Again, I've got the same basis expectation. That hasn't really changed given that time frame is pretty far out. And that puts us at a cash price of $6.42 for May delivery. And so, that's a 52 cent increase in just a couple of weeks, which is pretty remarkable. And so, again, you got to be realistic in thinking about, what it is that you're wanting to get out of corn that you still have in storage, what some different strategies might be. This would imply, a hedge strategy where you're going to hedge that $6.40 futures price and maybe speculate on some improvement in basis between now and the May delivery that I have here. And again, 2 cents over is not that much different than where we are currently on basis. And so that $6.42 delivery price doesn't include storage costs that we talked about on the first slide. And so you got to factor all that in. Delivery prices today are pretty doggone good, especially when you think about the storage costs you're going to incur to get out to May. The bottom half of the slide here looks at a new crop opportunity. So looking at harvest delivery this fall. And so you can see, again, going back to last month, we were at $5.59 for new crop corn futures. I had us at 20 cents under for a basis expectation in Central Indiana. That puts us a cash price of $5.39. This morning, right, those new crop corn futures were at $5.89. Same negative 20 basis. That puts us at a cash price of $5.79. So again, that's 40 cents higher than we were just a couple weeks ago.
So time out here. I'm catching a math there, I think. 589 and 20-cent basis, you'd be at 569, right?
69. There you go. Well, math can be hard sometimes. So 569. So that's 30 cents higher.
That's okay, Nathan. You're human.
Still, we're looking at cash prices for fall delivery that are significantly higher, in my opinion, than they were just a couple weeks ago. And so, you got to really be thinking, about what your strategies are for new crop corn. We could talk about a lot of different strategies, and there's a lot of information as far as what's going to affect that. There certainly is upside as we think about markets over the next several months here. We talk a lot about the seasonality in futures, and so we would typically expect to see some improvement in futures here over the next several months based on that seasonal pattern. But we're at very, very favorable price levels, and it doesn't hurt to have people thinking about, is this a point in time where we want to be thinking about making some small incremental sales on those new crop corn bushels.
So I guess let's think about what would be the downside risk from here. And I guess I think of a couple of things. One is maybe the weather patterns change in South America, and all of a sudden the weather down there is perfect, and the production estimates, instead of shrinking, as a lot of people seem to expect, all of a sudden start going the other way. That's possible. I'm not saying it's going to happen, but that's a risk. The other risk, which we're going to talk about more a little later, is what happens to acreage this spring, right? Because that's going to have an influence here on those new crop prices. And probably as much as any year in recent memory, we've got some uncertainty about what the corn and soybean acreage numbers are going to look like. So we'll talk about that more a little later. But those are probably the two downside risks. The reason to hang on, Nathan, I think, based on your research, would be seasonality. Yeah. On a seasonal basis, you would suspect that we'd like to see maybe some continued strength into the early spring, maybe even mid-spring, right? That would be kind of normal.
Yeah, typically, as we get to kind of the May, June, July timeframe, right around planting, as early season, that the crop is in the ground, that's when we tend to see, what people like to refer to as a weather premium, right? So we have good weather, bad weather, and that can really start to influence these markets. And so that time frame would be when we historically see those peaks. But any time between now and then, we typically think about incremental sales kind of as that market is following that seasonal pattern of kind of increasing prices.
All right, so let's turn our attention to soybeans real quick. So USDA did make a small change in the balance sheet for soybeans. They increased the crush estimate, I think, by 25 million bushels, and that brought down the carryover by 25 million bushels as well. That puts our ending stocks as a percentage of usage at about 7.4%. We were up close to 8% when I showed this chart a month ago, so it's a little tighter on the U.S. side than what we had before. But again, I think the attention is really focused on what's going on in South America, not so much on what's taking place with the U.S. balance sheet. USDA did reduce their expected Brazilian production. This month they pulled it back by 184 million bushels. CONAB, the Brazilian agency, just this morning released their estimate, and compared to their prior estimate, they pulled their expectation for Brazilian production down by 550 million bushels. So that explains, I think, for our viewers why we were seeing the strength in the soybean futures market this morning. It was the fact that the Brazilian agency pulled back their production estimate much harder than what USDA did. I think USDA is taking a fairly conservative perspective here. I would expect them to see that pull back their numbers on future reports as we get a little farther into the production season. USDA also reduced their estimate of Argentina's soybean production by 55 million bushels. Interesting that they pulled back soybeans a little bit and didn't touch their corn number. I think a lot of people would have expected both of those to come down. When you combine those and look at what's taken place, if you start looking at the CONAB numbers and think about the major exporters, Brazil, Argentina, and Paraguay coming out of South America, that starts to pull South American production not all the way back to 2017's level, but kind of in between that 2017 and 2018 level on your chart. And if that happens, that really does tighten supplies on a worldwide basis. A little bit like what we did on the corn, if you look at the major exporters' ending stocks as a percentage of usage, USDA's numbers got it at 15% this year, down from 17% last year. You go back and look at 2011, 2012, those numbers were in that 14 to 16% range. It would not be surprising to see that come down on future reports. In fact, if you plug in CONAB's numbers that they released today, you would already be back in the ballpark of where we were in 2011. I didn't actually compute that exactly, but that would be pretty close. And if we see any further weather problems in South America, any further yield reductions, obviously it would tighten it even more. That's the bullish case for soybeans. So like you did on corn, you've looked at current opportunities versus storage opportunities for soybeans, as well as some new crop analysis as well. So take a look at that, Nathan.
Yeah, so again, start out, let's just look at these forward cash contract bids for soybeans at a location here in central Indiana. Very similar to corn, right? Those cash bids, again, the darker gold line across the bottom there are relatively flat or even decreasing as we look out forward here over the next several months. And so, again, that just is two factors into that. One, right, carry in futures market. We have little to no carry in the soybean futures market, similar to corn, and then appreciation in basis. And again, there's a little bit of appreciation in the soybean market, or at least in these bids that I've used here. But again, not a whole lot that would change kind of the trend in that line there. And so again, comparing those with some implied break-even prices. So if you were going to store, here over the next several months and forgo the $16.10 cash price that's available today, what would you need to sell for? Again, on-farm storage scenario and a commercial storage scenario. And so again, if you're going to look at storing, into the summer, say June, you'd need to be selling soybeans for $16.46 a bushel under that on-farm storage scenario and $16.58 per bushel on that commercial storage scenario. And so again, those are very big numbers. And as you think about soybeans that you maybe have in storage, how are you going to get from the $16.10 cash bid that's available today to those prices? What strategies might fit? It certainly isn't going to be this forward cash contract based on the bids that are out there today. And so you need to be a little more creative in thinking about, what it is that you think is going to get you there, whether it's futures basis or anything like that.
So it's an interesting market structure both for corn and soybeans. When you look at the bid structure that's out there, it's providing a disincentive to store. And that's indicative of a market situation where the market is recognizing that supplies are somewhat tight, wanting to bring those quantities of bushels of corn and soybeans to market now versus in the future, which has some other implications for the futures market, right? But the basis side that people are looking at is relatively strong on the nearby. The other point I would make is there's a couple of markets that I kind of monitor on a daily basis. I would encourage viewers that are thinking about making some sales to monitor this pretty tightly, because I've seen some situations where that basis changed significantly from one day to the next, right? In one of those markets I was watching here in central Indiana, they were offering a premium out a couple of months for a little while, and then it disappeared. Obviously, they had something going on internally that caused them to do that, and so you need to pay attention, right? That's one of your messages with the basis tool as well, right?
That's exactly right, and that's I've seen the same thing, right? There's been a lot of volatility in those basis bids, kind of both directions, and so paying attention to what's going on and looking for those opportunities. And again, that's a great point. The basis tool also gives you a little bit of a way to gauge, right, where those basis bids fit into maybe where you would expect them to be for that time of year. So again, starting out here, we're looking at soybean basis, central Indiana. What's going on currently is the black line, and then I've got the historical 2-year average for soybeans there as the blue line. The 2-year average is just typically what I would use based on some research that we did as the best forecast for soybean basis. But you gotta really think about what's going on here, right? So we did some research that kind of led to these thumb rules: 3 years for corn, 2 years for soybeans. But I don't want to get too technical here, but looking at 2-year average for soybean basis, you can really be swayed one way or the other depending on what happens in those years. And while that might be the best forecast over a long period of time, if we think about what's going on in here, it's interesting to see that current basis bids are weaker than that historical average. That kind of catches your attention at first glance. But if you think about it, right, what is in that 2-year average? Well, last year we had very strong soybean basis all year. And so that could potentially be pulling that up. So, we were talking before and I looked, if you looked at a 5-year average, and again, there's very little difference between 2, 3, 4, 5, right? That you're really starting to split hairs at some point. We just kind of stick with the thumb rules that we've created. But if you just take the last 5 years instead of the last 2 years, and the reason you would do that, right? You pull in more years, you kind of smooth out that moving average. When you do that, right, it pulls that historical average, it pulls that blue line down. And we actually have stronger soybean basis relative to that 5-year average now than what that historical 5-year average. So just the tool is really useful in that sense to think about those sorts of differences and changes. And so, you kind of have to put into context what's kind of going on in some of those charts.
So I have to plug the tool here, Nathan, because one of the cool things about the tool is if you want to look at a 5-year average, you can do it.
That's right.
The data is out there. There's a box, we don't show it on this particular screen, but there's a box out there that allows you to select the years that go into that blue line average. And you can, with a couple of clicks, look at a 5-year average instead of a 2-year average. The other point I would make is that when you use the averages to forecast basis, what you're essentially doing is assuming that the market structure is unchanged from the period in time when the averages that you've computed were taking place. So when you compare today or this current year's basis to the most recent 2-year average, you're just kind of saying, well, I think the market structure now is the same as it was during the prior 2 years. How's it compare? Well, I think your point is, might not be exactly the way it was the last 2 years. We actually had some unusual things going on the last couple of years, which is why you might want to look at a longer term basis. And the other thing, of course, you can do is just compare a single year in the past to the current basis, which I find kind of fun to do and interesting as well.
Yeah, and I think so both of those points are very important, right? One is you have the flexibility to average across as many years as you want. And again, as you pull more years in, you smooth out, right? And so that's why you would think about maybe adding a 5-year average to look at. But then looking at the individual years, because sometimes for me, like I forget what happened the last 2 years, but I can go and look and I can tell you, all right, 2 years ago, this is what the basis pattern was relative to what's going on, and then last year, and then you can kind of use that to inform, okay, well with that, now I know a little bit more about that 2-year average, and maybe I decide I want to pull in some extra years to kind of smooth that out. So yeah, the tool has all of that flexibility, so I would definitely encourage people to tap into that and think about some different scenarios they want to go and look at.
Yeah, I think our message is if you go to use the tool, don't just use the default values. Play with it a little bit and see how it changes, and maybe that'll help you make some better decisions. So you've taken a look at Southwest Indiana as well?
Yeah, so again, looks pretty similar here in Southwest Indiana. We've had, again, basis for soybeans tracking pretty similar to that historical pattern, but again, maybe 10 or 15 cents below. That gap has been narrowing there in Southwest Indiana, so that's kind of an interesting point. In our newsletter last week, I wrote about kind of the bump in basis that we saw 2 weeks ago. And again, this Southwest Indiana is supposed to be a little bit of indicative of maybe some export demand given the river market there. But again, these are regional averages, and so there's a lot more than just the river that's reflected in this chart. And that's why I've got the next chart, which is again this new chart that I've put together where I'm averaging across only terminals that are on the river in southern Indiana and southern Illinois. And again, there you can see that those current basis bids are actually above that historical average, which would indicate some strength there for soybean basis along the river market, which again is reflective, at least in part, on what's going on in the export side of things.
As you look at that chart, you can really see how basis collapsed in the fall. And it tends to be weak in that September-October timeframe anyway, but you can see the impact of the storms and the closure of some of those export terminals down closer to New Orleans and how that fed back up the river, which is kind of interesting as well. So you've taken a look at some May delivery options as well as harvest delivery, and then again you've done the comparison to what we saw last month, and it's an even starker comparison when you look at last month versus today on soybeans, right?
Yeah, an even bigger change here. So I won't go through all the numbers. I'll just kind of stick to this month's, but I'll refer back to those kind of as I'm going through. But looking at just a scenario where we want to look at May delivery, so something in this crop marketing year for bushels that you still have on hand. We've got July soybean futures this morning at $6.15 per bushel, which again is $1, $2, $2.15, $2.20 stronger than what it was just a couple weeks ago, which is crazy. And then I've got a positive 15-cent basis for Central Indiana that I just pulled out of the crop basis tool. For that May time frame, which puts us at a $16.30 cash price for May delivery for soybeans. So again, if you were thinking about a strategy to kind of look at that price, you'd want to be hedging where we're at on 16 15 futures, and then you'd be speculating on that basis expectation that I've built in there of getting from where we are to 15 cents over. On the new crop side of things, so looking at maybe what some opportunities are for delivery harvest this fall, we've got November 22 soybean futures this morning at $14.58 per bushel. My expectation of basis based on information in the crop basis tool for Central Indiana is 30 cents under that. So hopefully I've got my math right here this time. That puts us at a $14.28 cash price for fall delivery. And again, look at that compared to where we were just 3 or 4 weeks ago. We're at, what is that, $1.60 or so difference. That's a pretty remarkable change in a really short period of time. And so again, we've talked about some of the things that are going on here from both the supply and demand side of things. There is certainly upside potential in these markets. There's certainly seasonal patterns that would tell us that we would expect to see some improvement in futures here as we think about what's going to happen moving into the spring and early summer months. But again, $14.28 on new crop soybean bushels are very good prices and things that people should be at least sitting down and thinking about, what is my plan? If it's not to make sales today, over the next several months, what is my marketing plan? When do I want to pull the trigger? And some different increments as we kind of move through and see how things unfold.
Yeah, again, so you think about from a seasonal basis, we would expect to see on a normal basis some improvement here over the next couple of months, but there's no guarantee of that, right?
That's
There's
right.
clearly some downside risk. Most of that downside risk is based on weather patterns in South America. And I guess for our viewers are probably well acquainted with this from last summer, how difficult it is to take weather forecasts and turn those into yield projections, right? We had a lot of trouble with that in the U.S., and a lot of us were surprised with respect to some of the dry areas in the U.S. that had surprisingly good yields last fall. So keep that in mind. But there is that seasonal element there. The other point that I would make, and this chart or this table really kind of helps illustrate that, if you're not in a mode of writing down these pricing opportunities once a week, just take a notebook and write them down and force yourself to think about the opportunities that are out there and why you're choosing to do what you do or not do. It's very instructive, and of course the movement we saw over the last roughly 4 weeks is unusual, right? We don't usually see that kind of movement, but it is useful to force yourself to write those down, think about it, and ask yourself, do I want to make a sale at these price levels? So, and the other point I would make is based on the seasonal pattern, and based on what's going on in South America, you probably do want to make some sales of new crop this spring, right? So in other words, be of a mindset and be ready to pull the trigger, right?
That's right.
Have that thought in advance. All right, so Michael, we want to turn and look at some things with respect to what's going on in corn production versus soybeans. And you've been looking at nitrogen rates, nitrogen cost, and maybe how that factors into people making that corn versus soybean decision.
Yeah, Jim, before we get to this slide, we did ask a question, the Ag Economy Barometer, and I believe, Jim, that 57% of those that were going to plant corn were going to keep the same N rate, and it was about a third that we're actually going to reduce the N rate. And what we want to talk about in this slide is there is some incentive to at least think about taking that N rate maybe down 20 pounds or so. And that's what this slide is illustrating. The 40 cents is similar to where we were last year. It's not that much different from a production maximum. You use 194 pounds, get 100% of the maximum yield. If you take that down to 90 cents, about where we're at today, you're looking at an N rate of 171, so backing that off about 20 pounds and only losing 2% of the yield. And certainly from a profit standpoint, that makes more sense than keeping the N rate at the same level you've had it for the last several years.
Yeah, so thinking that in percentage terms, you're really pulling that nitrogen rate, that optimal rate, down about 10%
Yes.
if you're buying nitrogen at current prices. And I think that's a good point. When I've talked about this with some producers, one of the points they make is not everybody's buying nitrogen at the price that's out there today, which is the 90-cent price. Some people were at the 80-cent mark, maybe they were at the 60-cent mark. So there are going to be some differences across farms depending on when you lock that input in, right?
Yes, definitely. This slide is quite different than last month, just like some of the information that Nathan was talking about is quite different. And what's changed? Well, the contribution margins for corn and soybeans are better, particularly for soybeans, compared to a month ago. And so let me explain this chart so everybody understands what we're doing here. If you think about the costs that we're excluding from the contribution margin, that's the costs that are represented in that overhead bucket. That's your cash rent or land opportunity cost, which on high productivity soil would be approximately $300. $290 to $300 would be an average for that. It also includes labor, which in our budgets is about $35 to $40, depending on the scenario you're looking at, would be in the overhead bucket. And then machinery ownership, that would be approximately $80 to $90 per acre. And so if you look at the $406 for high productivity, you've got that cash rent, you've got machinery ownership, and you've got labor, and they amount to $406. Let's start with that high productivity. Look at the difference between corn and soybean contribution margin and overhead. That's economic profit. The economic profit right now on high productivity soil is very, very large. Probably as large as what we saw at this time last year. Last year turned out better than we thought it was going to be from a budget standpoint, but this is a very good sign right now on high productivity soil. It looks like there's considerable profit. As we move to the average productivity, both corn and soybeans there are also above the overhead cost. But when you move to the average, notice that there's a bigger advantage for soybeans than there is at the high productivity. At the high productivity, yes, soybeans has a higher contribution margin, but the difference is smaller. As we move to average productivity and then we move to low productivity, soybeans looks much more attractive, and that's really changed in the last month or two. When we were doing this webinar last month, we were talking about don't count corn out. Corn's going to be very competitive for acres. Now we're leaning a little bit more towards there's going to be a lot of pressure for soybean acres to increase, not only in Indiana, across the Corn Belt, and in the United States. And I think these figures are help supporting that notion.
So Michael, help me out a little bit and help our viewers out. Tell us a little bit about what corn and soybean prices you have embedded in
yes,
this chart.
Yes, they're a little bit lower than what Nathan was talking about. $5.60 corn and $14 soybeans, and so it'd be even a little bit better if we used the prices that Nathan was talking about. And that just tells you how fast these prices have been changing.
Yeah, so for people making a decision today, and I think I've been telling people that the decision on corn versus soybeans is going to be fluid all the way up to the time planters roll. Yeah. But if you're making a decision today, it certainly suggests, particularly the high productivity soils, soybeans.
And typically when you do a budget, you can let that budget sit for a while, come back to a month. Yeah, it might be a little different, it didn't change very much. I mean, I'm talking the last 5 or 6 years, that's been the case. Not this year. You don't necessarily have to redo the budget every week. I do, just simply because I enjoy redoing the budget every week, but every other week at least, because costs change a little bit. And so you want to make sure you know what the break-even price, what your break-even price looks like while you're looking at your marketing plan.
And I guess the other thing to think about there is when you think about the cost that you've got embedded, compared to last year, you've bumped the cost up across these budgets, and what's the ballpark number?
Yeah, for corn it's getting close to 25%, and for soybeans 15%.
Okay.
Obviously higher on corn because of the nitrogen cost skyrocketed.
Okay.
Looking at 2021 and 2022, I wanted to talk about this slide just to show you that the prospects for 22 continue to improve. They're still not as high as 21, but as I've indicated before on these webinars, 21 was one of the best years in the last 50 years. It would be right up there. If it's not the top, it would be in the top 3 in terms of net farm income since 1973. 1973 is kind of a break there, and when we started exporting more, and so that's kind of a natural a time period to start with. And so 21 was really good. 22 is not terrible. I mean, as soybean prices increase, but also some strength in corn prices, even with these high costs, we're looking at some very strong net farm income in 22. I did want to contrast what I'm showing here with the USDA ERS net farm income forecast. If you listen to that, it was released about a week ago. If you listen to that, they were expecting net farm income to be down 4.5%. Well, it's different for corn and soybeans. I'm expecting that to be considerably larger than 4.5% that they were talking about for U.S. net farm income. On the cost side, they were expecting costs to be up 5%. That would be all types of farms. Again, for our corn and soybeans, I'm expecting costs to be up 20% if you average the corn and the soybean. That's the main reason why 22 does not look as good as 21. Prices are strong right now, very strong. If you compare them to what they were last February 21, it's just our cost structure is higher.
And I guess maybe to highlight how much this chart has changed over the last 30 days is earlier we were talking about 2022 having returns that were in the ballpark of what we saw in 2020.
Precisely. It was almost identical.
And now we're, instead of, that would have been roughly what, I think 125.
Yeah.
And now we're looking at in the ballpark of 200, right?
Yeah.
Big change.
And obviously this has implications where we're not going to focus on cash rents and land values today, but it obviously has implications on the strength we've seen in cash rents and land values. That's probably going to stick around for a while. One of the things I wanted to talk about is this corn versus soybeans. And one of the things we typically look at when we're looking at corn versus soybeans is the soybean to corn price ratio. Don't do that this year. I'm showing this chart to illustrate why that's a little dangerous this year, because if you use the prices that Nathan was talking about earlier, $5.70 corn and $14.30 soybeans, that would be a price ratio of 2.5. That's very similar to the average. That's not giving you the clear signal of how profitable soybeans really are compared to corn, because this year, what's so different about this year is we've got that huge cost increase compared to previous years, particularly for fertilizer on corn, and so this ratio is not as usable as it perhaps has been in the past, and so our ratio, just the bottom line here, the ratio is close to average. But that isn't telling us necessarily that we should be 50-50. Soybeans, particularly on that low productivity and average productivity, are very, very competitive.
So for clarity, on some of our previous webinars, one of the points we made a couple of different times was the fact that you shouldn't just throw in the towel on corn without doing a careful look at your own budgets. That's shifted quite a bit, and I would argue that what's really happened is the market has awakened to the fact that we need soybean acres in 2022, and then the market is trying to encourage or stimulate more planting of soybeans than what we was encouraging earlier.
Yeah, precisely. And when I do workshops around the state, one of the things I talk about is the fact that how big the market share for soybeans really is in Brazil. When you have weather problems in a country that contributes 40%. Has a 40% market share on the production of soybeans, you expect prices to change rather dramatically with tight stocks to use, and that's exactly what's going on.
Yeah, good point.
If we look at this chart, also has changed, but we were always talking about the fact that corn and soybean has similar profitability for this case farm. And this case farm is in a region where corn is very competitive. Typically, we have some continuous corn sometimes in west central Indiana, so it's not in a region necessarily where corn is not competitive compared to soybeans. But as this chart indicated, with that large increase in soybeans, it's actually an advantage towards soybeans, even on this case farm.
Yeah, good point.
Looking at that a little closer, I'm using $14 soybean price. Nathan was talking about $14.30, so maybe somewhere in between that $14 and $14.50 line is where we need to be talking about. And I don't want to get too repetitive here, but again, this just shows you that on that average productivity, you'd have to have pretty high corn prices for corn to look better than soybeans. And on the high productivity, though, is a little bit different. Corn's hanging in there a little bit better on that high productivity soil. And so the bottom line, we're still going to see a competition for acres in Indiana. What's changed a little bit is I don't think we're necessarily going to be 50-50. I think it's going to be slanted towards more soybeans. And that isn't that different from what we've seen the last 5 or 6 years, but I think that's going to be the case again this year.
And I would argue compared to last year, we're going to see more shifting than what we have.
Yes.
Right. So, and it's been interesting. I guess you and I have both been doing some meetings around the state and visiting with producers, and we've talked to a number of producers that are making some shifts, and it's the magnitude of the shift is a little unclear, but clearly people are thinking about this, right?
Yeah, and one of the things that we talk about when we talk about this corn versus soybeans is you look at the high productivity soil and you look at the total cost per acre, it's right at $1,100 per acre. So it's some sticker shock. saying, do I want to put in a crop at $1,100 per acre? Do I want to plant more corn and soybeans when I'm spending $1,100 per acre? And I think that enters people's mindset a little bit when they're looking at corn versus soybeans.
I think you finance people call that a capital constraint.
Yeah, there could be a capital constraint there. Though having said that, solvency and liquidity is pretty good, and so don't count corn out. You do the budget and compare the profitability between the two. What we're trying to do here is just show you how much difference there really is in the I states between this corn versus soybean acreage. There's less difference on average between Illinois and Indiana, but certainly since 2007, Illinois has had more corn than soybeans compared to Indiana. Indiana is the green line here, and so we're kind of on the bottom there. Illinois is the brown line, and then Iowa is the black line. It's very uncommon for Iowa to drop down to that 1.25, but you can notice it came very close in 21. And so if Iowa's going to have more soybean acres, that's going to take that ratio to about the lowest it's been since before 2007. So that would be quite different than what we typically see in Iowa if we see more soybeans in Iowa. Illinois, probably closer to 50-50. It was very close to that last year. And then Indiana hanging below that 50-50 like it has for the last several years.
And I guess for our viewers, we did look at the corn nitrogen rate calculator numbers for Iowa as well as Indiana.
Yeah.
We only showed the slide for Indiana. But actually the results are quite similar for Iowa, right?
Yeah,
so the incentive to
yeah.
maybe shift acres is probably about as strong in Iowa as it is here. Is that correct?
Yeah, it's very similar. One of the, what we're not talking, what we haven't shown necessarily is the fact that Iowa corn yields are better than the Indiana corn yields on average, and so that's why you see more continuous corn in Iowa. It's less of a problem from a profitability standpoint than it is in the Eastern Corn Belt. We just haven't seen much continuous corn in Indiana since 2007.
But the one constraint on continuous corn is you typically look at bumping up the N rate.
Yeah.
This is a year when
Yes.
that's a bitter pill to swallow.
That's a very good point, yeah.
That's a bitter pill to swallow at
Yeah.
these kind of nitrogen prices, right? So Michael and I have been debating quite a bit what might happen in the Western Corn Belt. I'm personally inclined to think we might see more shifting than Michael thinks in the Western Corn Belt.
I'm starting to become a believer with the recent change in soybean prices.
Yeah. But I think it's going to be fluid, and the market's going to continuously respond. And we didn't put it up earlier, but Informa had released, I think, some acreage estimates here about 10 days ago. And they suggested a fairly small change in soybean acreage, I think of only about 600,000 acres, and increase in soybean acres. And I think the market clearly is thinking that's not enough, right? So.
This is just looking at Indiana a little bit closer, looks from 2007, so we can see the numbers a little bit better. And definitely in 17, 18, there was a strong advantage towards soybeans. We had some trade issues back in those days, and so that's partly what was going on. Soybean price was relatively weak compared to corn. But even in 19, 20, and 21, we've been 95%, 96% in 21, and in between 90 and 96% in 19 and 20. And so certainly seeing something like 2020 or 2021 would be my best guess at this point of where we might end up in terms of the ratio of corn to soybean acreage. Just finally, I did talk about upward pressure on cash rents. It's just a slightly different way of looking at that. The net return to land is going. It looks like it's going to be above cash rent for 3 straight years if prices hold in 22 and costs don't increase more than they already have. It's been a while since we've seen 3 straight years above that cash rent line. We have to go back to that 7 to 13 period, and we all can see what happened to cash rent during that period. And so you start asking yourself, are we in line to see similar increases? I'm not there yet. I don't think cash rent's going to do what it did from 7 to 13, but it really depends on how good 22 really turns out and then what the prospects look like past 22. And so certainly some upward pressure on cash rents. It's just a question mark whether that's going to have legs into 23, 24, 25.
I would argue, looking at the chart, Michael, it probably does have legs into 23.
Yeah, I would agree. Since the 22 keeps improving, that's certainly going to be a very positive influence on 23. And so I would not be surprised. I mean, this is a long ways out there, folks, but I would not be surprised 5-10% increase in 23. when we start negotiating in 22. There's going to be some tough negotiations in the fall of 22 because it looks like you're going to be coming off a pretty good year, and probably the prospects for 23 are not going to look horrible. And so there's going to be negotiations are going to be tough again in the fall of 22 for 23 rents.
And as we think about spring auction season for farmland sales, the Ag Economy Barometer these last couple of months, both the short and longer term index has been coming down a little bit, but I don't think that really reflects a negative viewpoint. I think it reflects the idea that prices have already gone up quite a bit.
Yeah.
But given what's going on now, it's going to be pretty strong.
Yeah, to see a 20-30% increase in both, from 21 to 22 and from 22 to 23, that would be a bit of a stretch. But certainly seeing some upward pressure, 5-10% in that 5-10% compared to where we are today, you can start to see how that could easily happen.
Yeah. So let's just kind of wrap things up here. And thinking about where we're at in these both corn and soybean markets, we're in a weather market, right? It's a South American weather market, and we're not maybe acclimated to that happening as often as it does in the summertime here. But I think that has some implications with respect to marketing decision making. It means you need to be ready to pull the trigger. It means you need to be monitoring very carefully, not only basis, as we've encouraged in the past, but obviously these futures prices, and look at the opportunities and be ready to make some sales, not only on old crop, but also on new crop. But think about that on an ongoing basis going forward here. And so with that, we're going to have our next Outlook program is actually going to be a podcast because of some travel challenges that we're facing. Both Michael and I will be at the Commodity Classic down in New Orleans. And so instead of doing a video program like this, we'll do our next Outlook on the podcast, the Purdue Commercial AgCast. And if you're registered for this, you'll obviously have the opportunity to link into that, and we'll make that available. All the details will be on our website, purdue.edu/commercialag. So with that, I want to thank everybody for joining us, and I want to thank our participants today, Michael Langemeier and Nathan Thompson, for their help. And on behalf of the Purdue Center for Commercial Agriculture, I'm Jim Mintert. Thanks for joining us.